In the landscape of global power, few institutions are as influential, as omnipresent, and yet as fundamentally misunderstood as the Federal Reserve of the United States. It is an entity that can move global markets with a single press release, an institution whose decisions dictate the value of the money in your pocket and the interest rate on your mortgage. Yet for most, it operates behind a veil of complexity, its inner workings a mystery. Its very name, the Federal Reserve, is a masterpiece of political branding, designed to inspire confidence by evoking the full faith and credit of the U.S. government. But what if that name is a misnomer? What if the institution tasked with protecting the public's economic interest is, by its very design, a conflicted hybrid, part public servant and part private cartel? In today's episode, we will deconstruct the myths surrounding the Federal Reserve. We will journey back to its secret origins on a private island, dissect its strange and conflicted structure, and expose the alchemy through which it creates money. Our purpose is not to merely critique, but to understand, to pull back the curtain on one of the most powerful engines of the modern world, and examine the consequences of its design for every single one of us. To comprehend the Federal Reserve's immense power today, we must first travel back in time to an era of profound financial chaos. The system we have now was not the product of a grand, open debate about the future of the American economy. Instead, it was forged in secrecy, a direct response to a banking system that was designed to stabilize the banking class by transferring systemic risk upward. Before 1913, the American banking landscape was a minefield of recurring panics. The system of national banks lacked a central lender of last resort that could inject cash when fear took hold. The result was a vicious cycle. Banks would respond to panics by suspending convertibility, refusing to exchange deposits for cash. This breakdown of trust was so severe that certified checks often traded at a discount to cash, a currency premium, making the chaos tangible for everyone. The Panic of 1907 was the breaking point. It was a particularly severe crisis that saw widespread bank runs threaten to bring the entire financial system to its knees. This systemic failure was the political catalyst for change. In the aftermath, Congress passed the Aldrich-Vreeland Act of 1908, which not only authorized emergency currency, but, more importantly, created the National Monetary Commission to devise a permanent solution. That solution, however, was not crafted in the halls of Congress. It was born in a secret meeting held in November 1910 at the exclusive Jekyll Island Club, a secluded resort off the coast of Georgia. For 10 days, 6 of the most powerful men in American finance met under a cloak of secrecy so complete that they didn't publicly admit the meeting even happened until the 1930s. The attendees were not disinterested public servants. They were representatives of the nation's dominant financial empires: J.P. Morgan, the Rockefellers, and the investment house of Kuhn, Loeb, and Co. Here lies the foundational conflict of interest. The very Wall Street interests that reformers called the money trust, the concentrated power they sought to regulate, were the ones secretly writing the blueprint for their own regulator. The plan that emerged, known as the Aldrich Plan, was designed by bankers for bankers. Of course, a plan written by Wall Street could never pass a progressively minded Congress openly. What followed was a masterclass in political maneuvering. The final legislation, the Federal Reserve Act of 1913, was a carefully engineered compromise. It took the core of the bankers' Aldrich Plan and merged it with democratic demands for public oversight and a decentralized structure. The result was a unique and intentionally conflicted entity, a hybrid public-private system. It was designed to look like a public institution, accountable to the people, while retaining the essential features of a privately influenced central bank that would protect the interests of the banking sector. This compromised origin story is not just a historical footnote. It is the key to understanding the deep-seated institutional conflicts that define the Federal Reserve to this day. The hybrid structure of the Federal Reserve is not an accident of history. It is its defining feature. This design is a deliberate and sophisticated mechanism built to achieve two seemingly contradictory goals. Its true genius lies in its ability to be independent within the government rather than independent of government. a crucial distinction that allows it to insulate monetary policy from democratic accountability while harnessing the full power of a public safety net. The public component is the one we are most familiar with, the Board of Governors in Washington, D.C. This is the federal part of the Federal Reserve. Its 7 members are appointed by the President and confirmed by the Senate, giving it the appearance of a conventional government agency. But beneath this public facade lies the private component, the 12 regional Federal Reserve banks. These are not government agencies. They are set up by statute as private corporations, acting as the operational arms of the system. And it is in their ownership and control that the true nature of the system is revealed. So, who owns these regional Federal Reserve banks? The private commercial banks in their districts do. By law, private member banks are required to purchase stock in their regional Fed. In return, they receive a guaranteed dividend, creating a direct financial link between the commercial banking sector and the central bank that regulates it. This stock grants these member banks significant power. They elect 6 of the 9 members of their regional Fed's board of directors, specifically the Class A and Class B directors, while the Board of Governors appoints the 3 Class C directors. This creates a permanent feedback loop where the regulated have a direct hand in choosing their regulator, an arrangement that would later prove to be the perfect incubator for the moral hazard that brought the system to its knees in 2008. This system of 12 regional banks was designed to create the impression of a decentralized system. In reality, the most critical power is highly centralized in a single, insulated body in Washington, the Federal Open Market Committee, or FOMC. The FOMC is composed of the 7 governors and a rotating group of the regional bank presidents. This is the committee that sets the nation's monetary policy, including interest rates and quantitative easing. Crucially, the FOMC operates with a significant degree of opacity. Its meetings are private, and it is not subject to a full public audit. This lack of transparency is a core feature, not a bug, shielding the most powerful economic decisions from direct political accountability. This brilliant conflicted architecture is not merely a curiosity of governance. It is the fortress that guards the Fed's most profound power, power that borders on alchemy, the ability to create money from thin air. This isn't a metaphor, it's a technical reality, and it's accomplished through 2 primary methods: the century-old process of commercial bank lending and the more modern aggressive intervention known as quantitative easing. Understanding these mechanisms is essential to grasping the Fed's true influence. For most of its history, money was created primarily by commercial banks through a system called fractional reserve banking. The process is simple yet powerful. When you deposit, say, $1,000 in a bank, the bank is only required to keep a fraction, the reserve, on hand. If the reserve requirement were 10%, the bank would keep $100 and lend out $900. Here's the magic. That $900 loan creates a new deposit in another bank, which then lends out $810. This process continues, expanding the money supply with each new loan. The crucial point is that this new money is created out of debt. Recently, however, this system underwent a radical change. The Federal Reserve set the reserve requirement to 0. With the move to a 0 reserve requirement, the textbook money multiplier is dead. The Fed has effectively untethered commercial banks from a key historical constraint, shifting the primary limit on money creation from physical reserves to the much more subjective metrics of capital adequacy and market demand. This brings us to quantitative easing. This is the mechanism through which the central bank itself creates money, not from debt, but out of nothing. The process is disarmingly simple. The Federal Reserve purchases assets, typically government bonds, by creating new electronic reserves on its own balance sheet and using them to pay commercial banks. With a few keystrokes, the Fed injects brand new money into the financial system to increase liquidity and lower long-term borrowing costs. The scale of this operation has been staggering. At the end of 2007, the Fed's balance sheet stood at around $700 billion. By 2022, it had ballooned to roughly $8.3 trillion, a more than tenfold expansion. This process is known as debt monetization, where the central bank effectively finances government spending. As one analysis bluntly states, it is equivalent to simply printing money in the first place to buy goods. When this happens, the reversal is called quantitative tightening, where the Fed allows bonds to mature or sells them, causing the money it created to disappear from the system. These mechanisms are not just technical exercises. This power to create and destroy money at will has profound real-world consequences, fundamentally altering the relationship between the government, its finances, and its citizens. We tend to think of the Fed as an economic referee, separate from the political arena. But what if its most important function is not economic at all? What if it's political, acting as the indispensable silent partner that funds the modern superstate? By providing a limitless backstop for government borrowing, the Fed fundamentally removes the natural financial and political constraints on government spending, especially for the most expensive of all government endeavors, war. Historically, financing major conflicts was a politically perilous task. Before the Fed, large-scale borrowing for wars like the War of 1812 or the Civil War had immediate and painful consequences. The government had to issue visible bonds to the public and face the harsh judgment of the open market, often leading to instability, currency crises, and politically unpopular taxes. Congress had to directly confront the tangible costs of its decisions. The Federal Reserve changed this dynamic entirely. The Fed became the ultimate guaranteed buyer of government debt. Through mechanisms like quantitative easing, it can absorb trillions of dollars in U.S. treasuries, allowing Congress to finance massive deficits without facing punitive interest rates. The Fed effectively absorbs the political risk, transforming the immediate, difficult cost of spending into a delayed, hidden, and widely misunderstood economic consequence. That hidden consequence is inflation. When the central bank monetizes debt, it expands the money supply. If this outpaces real economic growth, the purchasing power of every dollar declines. This is inflation, and it functions as a stealth tax. Unlike income taxes passed by Congress, this tax is levied through the discretionary decisions of the insulated FOMC. It is also deeply regressive. Rising prices disproportionately harm those on fixed incomes, savers, and lower-income households whose wages don't keep pace. This mechanism engineers a direct wealth transfer known as seigniorage. The government and the large financial institutions closest to the money creation process get to spend the new money first, before it has circulated and caused prices to rise. They get to use it at its full undiluted purchasing power. As that money makes its way to the rest of the population, prices have already begun to adjust upwards. This effectively transfers real purchasing power from the public to the state and its primary financial partners. This power to fund the state without direct taxation doesn't just enable fiscal policy, it profoundly impacts the stability of the entire economy and the financial behavior of every individual. The central and most damning critique of the Federal Reserve is a profound irony. An institution created to promote financial stability has become, in the eyes of its critics, a primary source of economic instability. By systematically intervening in markets, the Fed distorts the price signals essential for a healthy economy, institutionalizing reckless behavior and generating the very boom-bust cycles it was meant to prevent. The Fed's primary tool for intervention is the manipulation of interest rates. As critics from the Austrian School of Economics have long argued, by artificially suppressing rates below their natural market level, the central bank sends false signals to entrepreneurs and investors. Credit becomes excessively cheap, encouraging malinvestments, projects that only appear profitable because of the distorted cost of borrowing. This fuels an unsustainable economic boom. Inevitably, this expansion leads to inflation, forcing the Fed to raise rates. The cheap credit evaporates, the malinvestments are exposed as unprofitable, and the painful bust or recession follows. Critics like Murray Rothbard argued that this was precisely the pattern that led to the Great Depression and the 2008 financial crisis. The Fed, in this view, is trapped in a perpetual cycle of managing crises caused by its own prior interventions. This cycle of intervention has institutionalized a dangerous phenomenon known as moral hazard. This was laid bare during the 2008 crisis and the bailouts of institutions deemed too big to fail. Large financial firms are free to take on enormous risks, often fueled by the cheap credit the Fed provides. When these bets pay off, the profits are privatized. But when they fail, the Fed steps in as the lender of last resort, and the losses are socialized, transferred to the public. This implicit guarantee encourages even riskier behavior in the future. This perception of a rigged system is only reinforced by documented instances of corruption. The case of a senior manager at the Richmond Fed who pleaded guilty to insider trading using confidential information to personally profit illustrates how the system's proximity to power and lack of transparency create irresistible opportunities for personal enrichment and further cements public mistrust. This diagnosis of systemic instability, distorted incentives, and insider corruption leaves us with an unavoidable imperative. We must fundamentally re-examine the source of the rot. Ultimately, the debate over the specific solution is secondary to the diagnosis of the fundamental problem, the concentration of immense discretionary power in an insulated, unaccountable, and structurally conflicted institution. Real, meaningful reform requires confronting the powerful political and financial interests that benefit from the current arrangement. The critique of the Federal Reserve is therefore not just an economic argument. It is a profound political challenge, a call to reclaim public control over the creation and value of money, and in doing so to restore a measure of stability, fairness, and accountability to our economic life. Now we will shift our focus from the perils of what is to the perils of what is to come, the fundamental structural transformation of the global monetary system. This evolution is not happening in a vacuum, but against a backdrop of fragile growth and significant risk. The global economy is currently projected to expand at a moderate, yet tenuous, rate of 3% in 2025 and a slightly better 3.1% in 2026. This mild outlook is largely propped up by temporary factors like fiscal expansion in some countries and improved financial conditions. However, the downside risks are substantial. Persistent inflation in the United States continues to be a major complicating factor, while pervasive geopolitical uncertainty casts a long shadow over global stability. And this isn't just a domestic problem. To fight that inflation, the Federal Reserve is compelled to maintain a tighter monetary policy. That tightening of U.S. dollar liquidity inherently raises the cost of capital for the entire world, putting immense strain on any nation holding dollar-denominated debt. This specific combination of sluggish growth and systemic risk creates the perfect environment for radical institutional change, compelling policymakers to seek new tools for control and stability. And in this environment of profound uncertainty, the world's central banks are not fading into irrelevance. Instead, they are actively engineering their next evolutionary phase. There's a popular narrative that technologies like the blockchain or distributed ledgers will finally make these powerful central banking institutions obsolete. Don't believe it for a second. These institutions are masters of adaptation, and they are strategically co-opting the very technology that was supposed to replace them, all in an effort to preserve their power. This brings us to the rise of central bank digital currencies, or CBDCs. The push for CBDCs isn't coming from you or me demanding a new way to pay. It's a top-down initiative driven by high-level policy objectives. The stated goals are laudable: making cross-border payments more efficient, bringing the unbanked into the formal financial system, and most importantly, defending their monetary sovereignty against the rise of private digital currencies. Now, there are two main flavors of CBDCs. There's the retail version, which would be a digital dollar or euro available to the general public, and there's the wholesale version, designed for settlement between commercial banks. And this is where the strategy becomes clear. Advanced economies are overwhelmingly pivoting toward the wholesale model. Look at the euro system, for example. They've already run successful experiments settling over 1.6 billion euros on a distributed ledger. Their future projects, like Pontes, expected in the latter half of 2026, are designed to create a sophisticated, distributed ledger technology-based settlement system for institutions. This is a politically safer, less disruptive path. It upgrades the plumbing of the financial system, making it more efficient while reinforcing the existing two-tier banking structure we've always had. But while central banks are busy building a more efficient, permissioned version of the future, a parallel revolution is well underway. one built on a radically different premise. This parallel revolution is, of course, the world of decentralized finance, or DeFi and Web3. It represents the fundamental challenger to the centralized model we've just discussed. At its core, distributed ledger technology offers an entirely new path for moving value across borders, one that completely bypasses the slow, expensive, and convoluted correspondent banking system that has dominated global finance for decades. For emerging economies, this isn't just an abstract improvement. It's a potential revolution in remittances, which are a vital lifeline for development and could dramatically reduce costs for a whole range of cross-border commerce. But the value proposition goes far deeper than just cheaper, faster payments. It's about the concept of self-custody, summed up in the crypto mantra. Not your keys, not your coins. This isn't just a technical feature, it's a philosophical declaration of financial sovereignty. By holding your own private keys, you eliminate counterparty risk. You are no longer dependent on an institution to hold your assets, giving you a degree of economic freedom from centralized control that was previously unimaginable. Of course, we have to temper this revolutionary narrative with a dose of reality. The DeFi ecosystem has its own systemic weaknesses. Institutions like the Bank for International Settlements are quick to point out the dangers of high leverage and liquidity mismatches that are common in this space. This is the so-called decentralization illusion, the inconvenient truth that for these complex systems to function, some level of centralized governance is always required. And it is precisely these points of centralization that provide a foothold for regulators, a clear reference point for authorities to enforce financial stability rules and prevent illicit activity. This is why institutions like the BIS aren't panicking. The system's own structure gives them a lever of control. So, the core battle that is shaping up is not just about competing technologies. It's about two fundamentally opposed architectures for society. One built on centralized control in the name of systemic stability, and the other on decentralized autonomy in the name of individual liberty. This conflict comes into its sharpest focus with the concept of programmable money. Simply put, this is money with built-in rules that dictate how it can be spent. You can immediately see the appeal for governments. Imagine distributing welfare or stimulus funds that are automatically restricted to essential uses, like groceries or rent. This offers a powerful tool for administrative efficiency and a way to dramatically reduce fraud. But the same technology that promises efficiency also poses a profound threat to individual autonomy and privacy. A government-controlled digital currency could easily become a tool for mass surveillance, allowing the state to track every single transaction you make, creating what critics rightly fear could become a totalitarian surveillance tool. The real policy debate, however, is more nuanced than a simple binary of efficiency versus freedom. The legitimacy of programmable functions is a matter of degree and application. A function designed for a clear welfare purpose, like ensuring aid is spent on food, might be seen as a justifiable, if intrusive, way to achieve a social good. But it's a very different matter when programmability is used for broad prudential regulation or unconventional monetary policy, essentially expanding the central bank's power into the realm of social engineering. This is the core of the concern. Not just that the state can see what you buy, but that it can control it. The very existence of proposed legislation like the Anti-CBDC Surveillance State Act shows just how seriously this threat is being taken. And this intense debate over control and autonomy isn't happening in a vacuum. It's deeply intertwined with much larger plans for global economic and social management. To understand the full picture, we have to place this digital currency movement within the context of the World Economic Forum's Great Reset agenda. This is a broad strategy for systemic renewal, aimed at achieving ambitious goals like the UN's Sustainable Development Goals, tackling everything from poverty to climate change. To achieve such goals, you need a financial infrastructure that can monitor and enforce them. Programmable, traceable digital money provides that infrastructure perfectly. This dovetails directly with the concept of the Fourth Industrial Revolution, which is described as the fusion of our physical, digital, and biological worlds. In a future economy of smart supply chains, automated factories, and an Internet of Things where machines are constantly transacting with each other, The payment layer itself must be automated and conditional. Programmable CBDCs are the logical lubricant for this machine-to-machine economy. They transform money from a passive medium of exchange into an active layer of governance. The technological path forward seems set, but the battle for its soul, whether it will be a centralized and monitored system or a decentralized and sovereign one, is becoming the defining geopolitical contest of our time. So where does this leave us? The future monetary system will almost certainly be a hybrid one. Centralized permission systems built by institutions will coexist with a regulated and contained DeFi ecosystem. The Federal Reserve and its global peers are not going anywhere. They are simply leveraging technology to reinforce their central role in the financial world. The conflict, then, boils down to its most critical form, a direct trade-off between systemic efficiency and individual liberty. Programmable money offers an unprecedented level of governance efficacy, a way to solve complex societal problems with surgical precision. But it comes at the severe risk of constant financial surveillance and the quiet erosion of our personal autonomy. And so, I'll leave you with this final thought. As this new architecture for money is being built all around us, we have to ask ourselves what kind of future we want. Because make no mistake, the choices we make today about the architecture of our money will ultimately define the architecture of our freedom tomorrow.